You think money is printed in a building with guards, vaults, and a government seal. You picture machines, ink, authority. That image is wrong. Because the moment you sign for a loan, money appears out of nowhere. No trucks, no printers, no taxpayers. And the most unsettling part, it wasn't created by the government. It was created by a bank clerk typing numbers into a screen. That's not a metaphor, that's the system. And once you see it clearly, you'll never hear the word loan the same way again. Let's slow this down. Right now, across the world, people are taking loans. Home loans, education loans, business loans, credit cards. Most of them believe they're borrowing money that already exists, saved by someone else, stored somewhere, waiting to be handed over. That feels logical. It feels responsible. It is also completely false. Because modern money doesn't work like water being poured from one cup to another. It works more like a spreadsheet that expands. Here's the uncomfortable truth that almost no one explains clearly. Most money is created when debt is created. Not before, at the exact same time. Let's walk through a simple story. You walk into a bank and ask for a loan of 10 lakh rupees. The bank approves you. What do you think happens next? Do they go into a vault? Do they move money from someone else's account? No. They open a computer system. They type 10 lakh rupees into your account. That's it. Your balance increases. Money has just been created, not transferred, not recycled, created. At the same moment, something else is created too, a loan entry, a promise that you will pay this money back plus interest. So on the bank's balance sheet, two things appear instantly: an asset, your loan; a liability, your deposit. The numbers balance, the system stays stable, and the money now exists in the economy. This is not a loophole. This is not corruption. This is not illegal. This is how modern banking is designed to work. Over 90% of the money you use every day was created this way. Not by the government, not by the central bank, by commercial banks. Quietly, digitally, legally. Now here's where things get strange. When you spend that money, it feels real. You can buy a house, pay fees, hire workers. But remember something important. Only the principal was created. The interest was not. Let that sink in. If the bank creates 10 lakh rupees but expects 11 or 12 lakh back over time, where does the extra money come from? It has to come from somewhere else in the system, which means someone else must also borrow. This is why the system needs continuous new loans just to keep functioning smoothly. Debt is not a side effect. Debt is the engine. Now zoom out. Multiply your loan by millions of people, by companies, by governments. This is why global debt keeps growing faster than the real economy. Because money enters the system as debt, but leaves only when debt is repaid. And when debt is repaid, that money disappears. It is destroyed. Yes, destroyed. When you repay your loan, the bank deletes the deposit balance and removes the loan asset. The money doesn't go back into circulation. It vanishes. Creation on the way in, deletion on the way out. Which means if borrowing slows down, money supply tightens. And when money tightens, things break. Businesses struggle, jobs disappear, markets panic. This is why central banks obsess over lending. This is why interest rates matter more than speeches. Because interest rates decide how expensive it is to create new money. Lower rates mean cheaper money creation. Higher rates mean slower creation. And when creation slows too fast, recessions happen. Now here's the irony. Most people think banks are just intermediaries, Middlemen. They think banks lend out deposits. But banks don't wait for deposits to lend. They lend first. Deposits follow. Your loan creates someone else's deposit when you spend it. So when banks say they're running out of money, what they really mean is something else. They're running out of permission. Permission from regulators, permission from capital rules, permission from risk models, not physical money. This flips the entire moral story we're told. You're told banks are careful stewards of scarce funds. In reality, they are licensed money creators. That license comes with rules, and those rules shape the economy more than elections do. Because banks don't create money equally. They prefer assets, real estate, large corporations, financial markets, not small businesses, not risky innovation, not people without collateral. So money flows where lending is easiest, not where society needs it most. This is one reason asset prices rise faster than wages. Money reaches houses before it reaches workers. And now, one more uncomfortable detail. The government doesn't directly control this process. Central banks influence it. They set rates, they provide liquidity, but they don't decide who gets loans. Banks do. Private institutions decide where new money enters the economy every day, quietly. And once you see this, certain headlines make more sense. Why housing bubbles form, why inequality widens even during growth, why financial crises repeat. Because the system isn't built around money as a public tool. It's built around money as a byproduct of lending. And lending follows profit. Not fairness, not stability, not long-term resilience. Now here's the part no one likes to talk about. This system works until it doesn't. As long as confidence holds, as long as borrowers keep paying, as long as asset prices keep rising. But when defaults rise, money disappears faster than it was created. Credit shrinks, spending falls, fear spreads. And suddenly everyone asks the same question: where did the money go? The answer is chillingly simple. It was never there in the first place. It was an agreement, a promise that tomorrow would be richer than today. So next time you hear about stimulus, bailouts, or credit growth, remember this: money is not a thing. It's a relationship between trust and obligation, between banks and borrowers, between the future and the present. And the real question isn't who creates money. The real question is this: if most money is born as debt, what kind of future are we building it for?